It's that exciting time of the month when your hard-earned paycheck finally arrives. You've sorted out the bills, and now you face a dilemma. Should your extra funds take a comfy nap in your trusty savings account, or should they embark on a thrilling financial adventure in the world of investments? Stick around, because in the next few minutes, we'll equip you with the knowledge to make the right balance between those two. Let's start with savings. When it comes to saving money, it serves two crucial purposes. First, it's your financial safety net, ready to catch you when life throws those unexpected curveballs, be it medical expenses, car repairs, or sudden job loss. It's your shield against spiraling into debt. But saving is more than just security. It's the fuel for achieving your short-term dreams. Whether it's that dream vacation, a down payment for a home, or launching a small business, having funds readily available empowers you to turn those dreams into reality. However, here's the twist. Savings accounts often offer unmatched security and liquidity, but their interest rates can be lower than inflation. Let's break it down. Imagine you have $1,000 tucked away in a traditional savings account. It's a safe and secure place for your money. Now, this savings account offers an interest rate of 1.5% per year. Not too shabby, right? But here's the twist. Out there in the real world, inflation is marching on at a rate of 2%. Now fast forward a year. Your savings account has earned you $15 in interest, bringing your total balance to $1,015. You might think you've made a profit, but wait. In that same year, prices for everyday goods and services have increased by 2%. Your $1,015 now has the purchasing power of $995 in the previous year. So, while you did earn some interest, your money effectively lost 0.5% of its value because it couldn't keep up with the rising cost of living. It's like taking one step forward and two steps back in the financial race. That's the hidden cost of playing it too safe with your money. So, the challenge becomes clear. How do you balance the safety of savings with the need for your money to grow? That's where the decision to save or invest starts to take shape. Now, when it comes to investing, it's a whole different ballgame. Investing isn't just about the numbers, it's the gateway to turning your financial dreams into reality, the path to long-term wealth creation and greater financial security. One of investing's primary goals is to outpace inflation. Historically, various investments like stocks have delivered average annual returns of around 7 to 8%, even after adjusting for inflation. Let me paint a picture of investing's potential. Imagine you decided to invest $1,000 in a standard world index exchange-traded fund, which is a diversified investment in global stocks. Fast forward a decade, and your investment has averaged an annual return of 7.5%. Your initial $1,000 has transformed into a significantly larger sum of approximately $2,061. That's the power of investing, turning a modest sum into a substantial asset over time. However, it's important to acknowledge that investing comes with its own set of risks. The values of investments can fluctuate, sometimes significantly, and there's no guarantee of returns. It's like a roller coaster ride with ups and downs. Yet it's precisely this risk that can lead to reward. Now, a quick word about liquidity in investments. Liquidity is how fast you can turn an asset into cash without messing up its price. Unlike a regular savings account, some investments, like stocks or real estate, may not provide instant access to your money. They can take time to sell, which could be a challenge if you need quick cash for emergencies. That's why maintaining an accessible emergency fund is a smart move. It ensures you have cash on hand for unexpected expenses while your investments continue to grow. So, the question arises, are you willing to embrace some risk in pursuit of your financial goals? This is where the choice between saving and investing takes the center and final stage. Now that we've covered savings and investments, you might be wondering, which one is right for me? Well, here are 5 vital points to help you decide what works best for you. Number 1. Know your money goals. First things first, figure out what you're saving or investing for. Is it an emergency fund, a house, retirement, or something else? Having clear goals helps you decide where to put your money. Number 2, get real about risk. Are you the play it safe type, or are you cool with a bit of financial adventure? If you want safety and easy access to your cash, saving is your primary go-to. If you're okay with some risk and want your money to grow over time, investing might be your jam. Number 3, mix things up. This is probably the most important point. Don't put all your cash in one place. A balanced money plan often means doing a bit of both, saving and investing. Keep an emergency stash in an easy-to-reach account and explore investment options that match your style. Number 4, check out different accounts. There are all kinds of savings and investment accounts out there, like regular savings, high-yield savings, stocks, bonds, and more. Each has its own thing going on, so check them out and see which suits you best. Number 5, tax perks. Some accounts, like 401(k)s and IRAs in the US, can give you a tax boost. That can make a big difference in your savings or investment plan. So, should you save, invest, or do both? It's all about finding your unique balance, a financial strategy that keeps your funds accessible for rainy days while allowing your investments to flourish in the sunshine. Your financial journey is uniquely yours, so set those goals, assess your risk tolerance, and craft a plan that helps you thrive. Thanks for joining us in this video. We hope you've gained insights into making smart money moves. Don't forget to subscribe for more valuable tips from Investor Express. Thanks for watching.